Michael Smith, founder of RockyMountainStartup.com. As an entrepreneur myself, I understand the challenges and exhilaration that come with starting a new business. As a business owner, you're going to make 1,000 decisions. Among the most important include selecting the appropriate legal structure for your business. Let's take a look at the 4 most common types of legal structures, which include the sole proprietorship, the general partnership, the limited liability company, and the corporation. A sole proprietorship is a business owned directly by one individual. The enterprise is merely an extension of the individual owner. This is the default business form for one person engaged in a trade or business. Agents and employees may be hired, but the owner carries all of the responsibility. Additionally, all of the profits and losses of the business are directly attributed to the owner. There are several advantages to the sole proprietorship entity. First, the owner has complete control over the business. Secondly, it's inexpensive to create, with very little that actually has to be done. Thirdly, it's easy to form and easy to operate. Again, there's not much that needs to be done to form a sole proprietorship outside of getting a business license. And running and operating a sole proprietorship is very easy, considering that there's only one person making the decisions. Furthermore, there's no double taxation. A sole proprietorship is just taxed to the individual. The income flows through to the individual's personal income tax returns. There are a couple of disadvantages to operating a business as a sole proprietorship. First, you're exposed to unlimited personal legal liability. The sole proprietorship is exposed to unlimited legal liability regarding his or her business and personal assets, which means that your personal assets may be at risk if your business is ever sued. The owner is subject to all the debts and legal liabilities of the business as well. Secondly, capitalization may be a problem, as the ability to raise capital for the company is limited to the individual's personal assets or assets that the individual can secure personally. A general partnership is a business enterprise entered into for profit that is owned by more than one person. The persons in the business are called partners. A general partnership may be created by a written agreement, an oral agreement, or by a simple handshake. No express agreement is necessary to create a partnership. The partnership is the default business form when 2 or more persons carry on a business for profit. Each of the partners is an owner and has a right to share in the profits of the business. As with the sole proprietorship, each partner is personally liable for any loss suffered by the partnership business. Therefore, partners are subject to unlimited legal liability regarding the debts and obligations of the business. One advantage to the general partnership is that it's inexpensive to create. No filing fees or legal fees are required to form. It's also easy to operate, as very few legal requirements are necessary for the operation. The owners simply need to obtain a business license. It can also have an unlimited number of partners. Capitalization. Because there are 2 or more persons who can contribute assets to the business, it's easier to raise capital for a general partnership compared to a sole proprietorship. There's also no double taxation. The partnership is simply a conduit to the individual taxpayer. Therefore, there is only one level of taxation, unlike a corporation. There are several disadvantages to the partnership form. First, unlimited personal liability. Each partner's personal assets are exposed to unlimited liability regarding the debts and obligations of the business, meaning that each partner's personal assets are at risk. Secondly, one partner can legally bind the others. When one partner takes action in the name of the business, the other partners are legally bound by such action. Therefore, each partner is personally responsible for the acts of other partners who act in the name of the business. Thirdly, a partnership can be accidentally formed. If 2 or more persons meet the definition of a partnership, then they're bound by partnership laws. A corporation is an entity separate and distinct from its owners. It is an organization formed with state government approval, which is designed to act as an artificial person to carry on a business. A corporation can acquire, hold, and convey property in its own name. It can also be sued and sue in its own name. Ownership interests in a corporation are represented by shares of stock. Therefore, the owners are called shareholders. The shareholders periodically elect a board of directors who oversee the affairs of the business. The board acts under the leadership of a chairman and elects corporate officers to manage the business. Corporations are typically divided into publicly held and close corporations. A close corporation only issues shares to family members or persons who know each other, whereas a publicly held corporation sells shares of stock to the public. There are a couple of advantages to the corporation, limited liability being one of them. Because the corporation is a separate legal entity, the shareholders are not personally liable for the debts and obligations of the corporation, assuming corporate formalities are properly followed. Secondly, the corporate form may attract investors. The issuance of corporate stock to investors may allow the corporation to add much needed capital to the business. A major disadvantage of the corporate form is double taxation. The business income from a corporation is subject to double taxation. First, the corporation must pay income taxes on its earnings, and then the shareholders and employees must pay tax on their dividends and wages. Therefore, two levels of taxation. Corporate formalities are also an issue. In order to maintain its status as a separate legal entity, a corporation must strictly adhere to corporate formalities such as annual shareholders meetings, formal board of directors meetings, and documentation of meeting minutes. In general, the corporate form includes more paperwork and accounting requirements than an LLC. For many businesses, the complexities of corporate formalities are cumbersome and impractical. An S corporation or subchapter S corporation is a small corporation whose owners have elected to be treated as a partnership for federal tax purposes. It's actually not a separate business form, but instead a tax election. It operates essentially like a traditional corporation or C corporation, with the addition of an S corporation election being made by filing Form 2553 with the IRS. Unlike a C corporation, an S does not pay taxes at the corporate level. Instead, the S Corp files a Form 1120-S and then passes its income, losses, deductions, and credits to its shareholders for inclusion on their personal income tax returns. S corporations must strictly adhere to IRS regulations in order to maintain its S corporation status. Other than that, it basically mirrors the advantages and disadvantages of a traditional corporation. The LLC is a hybrid business entity which combines the organizational flexibility and taxation benefits of a partnership with the limited liability protection of a corporation. Much like a corporation, an LLC is a legal entity which exists apart from its individual owners, called members. From a risk standpoint, an LLC offers similar protection from lawsuits to the individual owners or members as the corporation does. This simply means that the members of an LLC are not held liable in legal suits for the wrongs that his fellow members commit against third parties. Additionally, an LLC limits the liability of an individual from lawsuits brought by fellow members or managers of the LLC. This liability protection provides the member with corporate veil protection between their personal assets and their business assets. Limited legal liability, or in other words, the separation of your personal and business assets for liability purposes, is a major advantage of the LLC. Organizational flexibility and no corporate formalities, compared with the corporate formalities that must be kept up with a C corporation and an S corporation, are also advantages of the LLC. The LLC also does not have to deal with the double taxation of a C corp, nor the single class of ownership restrictions of an S corporation. Colorado now recognizes single-member LLCs, which means a small business owner that's by themselves can operate as an LLC. This means that a solo business owner can enhance their professional image in the marketplace by operating as a limited liability company as opposed to operating as a sole proprietorship. The LLC has become the most popular business form in the nation and in Colorado. The question is why? Well, there are several reasons. The first is partnership-type taxation, which simply means that the profits from the LLC business flow through to the individual's personal income tax return. The second reason is partnership-type flexibility in operation, which unlike the C corporation or the S corporation, the LLC is more flexible and does not have to adhere to the strict corporate formalities. Thirdly, the LLC enjoys corporation-type limited liability. Again, that just simply means that there's a corporate veil of protection between a member's personal assets and the business assets of the LLC. For more information and an online library of free resources for Colorado entrepreneurs, visit RockyMountainStartup.com.